In an investing decision, there are several things that come into play. One is analysis. And analysis is taking information, taking data, coming up with what you call a hypothesis. What is a hypothesis? It is something that I think is going to happen. So for example, the sneaker company, Adidas or Puma or Nike, and I say, okay, I've got all this data about Nike. Do I think the stock is going to go up or not? And by how much is it going to go up? A lot of that is analysis. Then you have what is called instinct. Many people call this listening to your gut. Instinct is more than just, does this feel right? It's more than that. It is a sense that one has that's born from experience. That is, if I have seen this situation in the past, how did it work out? And we have to actually be very careful about using instinct in investment decisions because it can make us irrational. Because sometimes, as human beings, we are wired to want to avoid loss. We want to avoid unpleasant things. The other piece is instinct. What do we mean by instinct? A lot of people talk about gut feel. That is, I have a gut feeling about this. I have a gut feeling that I should do this or I should do that. Instinct is much more than that. Instinct is a sense, an input that is born of experience. And for example, let's say I have seen in the past that when there's a hurricane, a lot of people lose their jobs. And so the economy suffers. That is data. But then that may give me an instinct that hurricanes are very bad for the stock market. The reality is, when you look at data, that instinct is not borne out. Hurricanes have a small impact on the stock market right after they occur. But in the long term, what moves the stock market is not this hurricane or that hurricane. It is what is happening to companies. So you have to be very careful about relying on instinct for investment decisions.